Okay, Bismillahirrahmanirrahim. Welcome to all of you at ACCA Prepare to Pass session of paper P2. My name is Ahmad Sarwar and I am the facilitator of this presentation session. And before starting the session, I want to give you some useful tips about ACCA paper P2. The most important point for the ACCA paper P2, if you really wanted to pass this exam in December session, you have to work hard on the basic concepts and basic key concepts of consolidation, and at the same time you should have a sound grip on the narrative part of the IFRS and as well as the application of the IFRS. So in this session, I hope all of you will get the benefit from this Prepare to Pass session. At the end of this session, we'll be having a mock discussion. So it's highly recommended to all of you to please do attempt the mock session and attempt the mock exam and take the mock debrief session. So it's very useful and highly recommended to attempt at least 3 to 4 mocks before appearing in the final examination. So the most of the students who failed in this paper are the one who lacks practice of the exam simulation. So the practice in the exam environment on examination-based questions and 3 hours practice is very important to pass this paper. So let's start with the first slide. Okay. So here we have the format of the exam. In the examination, we will be having a section A with 50 marks. That includes one consolidation-based question, which marks 35, and the second narrative part, which could be from any IFRS, and it will marks 15. Then from section B, we have 3 questions. And out of 3, we have to attempt at least 2 questions to pass this exam. So from question number 2 will be mostly based on the focused area, in which examiner asks question from a particular IFRS. It might be from IS2, it might be from IFRS 2, it might be from IFRS 9, or examiner can ask a question from any part of the syllabus. The question number 3 is a mixed based question, in which examiner mostly asks questions with 2 or 3 standards applying at the same time. And for question number 4, the pattern is like that. Examiner can ask anything from the syllabus, or it might be some hot topic or some current issues that is very hot in the exam from the professional world. In the professional world, it might be sometime examiner asks questions from integrated reporting and other important topics which are very relevant in the market. So moving towards the next slide. Here we have the pass rates of the P2 examination. Believe me, from the syllabus, if you can see the syllabus and the coverage of the syllabus, the pass rates is comparatively quite better, because examiner has a very basic criteria for judging the students on the grip of IFRS and the consolidation, and mostly students can easily pass this paper by just attempting 70 or 80% paper. But the marks or the paper that you have attempted should be solid. So if you have attempted the solid part, you will definitely and can easily pass this paper. So it's very easy to pass this paper. You can see the highest percentage is 58% and the lowest percentage is 44%, but the average is just 49 to 50%. So approximately 50% students will be able to pass the exams in every attempt. But if you follow my guidelines, believe me, you can all pass this exam in just first attempt. So here we have the examinable document of paper F7 and P2, you can click on the link and see the number of standards that is examinable and that is the requirement of the syllabus. So you can see the number of standards that you have to prepare. The list is given. Here we have the technical, most important technical articles. One of the article is from IFRS 16, is one of the most important standard the examiner can ask. Then we have IFRS 13 with us. Then there is a technical article on IFRS 15. Then there are 4 articles on financial instruments, one for deferred tax and one for IFRS 2. 2 articles. So these are very useful articles. So it's highly recommended to read these articles on a daily basis so that you will have a sound grip on these standards. So here we have the session planner, and day 1, day 2, and day 3 will be focusing on some of the past papers, how to attempt the questions in the examination. So this session is all about the passing the exams rather than having the detailed knowledge of the syllabus. So my focus will be on to pass this exam. So from in day 1 and day 2 and day 3 we'll be focusing on the past papers in which we'll be completing the consolidation and IFRS questions of each past paper. We'll try to focus on past papers from day 1, 2, and 3. On day 4, we'll be having some past papers, and there will be a detailed working on IFRS 16 actually, that is leases. It superseded IAS 17. So there's a technical error in this slide. So we'll be focusing on some of the past papers and as well as detailed discussion on IFRS 16. On day 5, we'll be focusing on IAS 13 and one of the most important standard for this session, that is IFRS 15 revenue, and that is relating to the fair value. And on day 6, we'll be having a mock debrief session. So let's move on to the next slide. So we are going to start from the past paper of this session. I think we have to click on the link. I think it's not working. So let's start. From the past papers. I think this link is not working. So what we can do is to copy this link and paste it on the yes, here on the screen you can see the past paper of ACCA paper 2 for the recent attempt, that is hybrid paper for the March and June session. The September session examination is not yet available. Now here you can see on the screen that we have three companies, that is Diamond, Spade, and Club. The first company is the Diamond company. Then we have a Spade company with us. from where I can change this. I think it's disturbing me. Okay, so let's start. Here you can see there is a company with the name Diamond, Spade, and Club. These are the three companies. These have different property, plant, and equipment assets value. The property, plant, equipment of Diamond Company is 1062. Then we have Spade Company, that is 1210, and finally we have the Club Company that have 1265. Investment in subsidiaries means that these two companies are actually the subsidiaries of Diamond Company. The one is Spade, the second one is Club Company. And then we have investment in Herd. We don't know much about Herd. You have to refer to the note to gain the understanding about what is the meaning of investment in Herd. Then we have other financial assets that is relating to IFRS 9. So you can see that there might be some implications of IFRS 9. So then we have simple current assets, then we have equity investment, retained earnings with us, retained earnings, other component of equity, non-current liabilities, and these are some basic areas. I'm moving towards the. Now, you can see there are some notes available here. So, what should be the approach to attempt this type of question which score and which can give you exact 35% marks? So for this 35% mark, you have to break the question into different components. The first component is the basic knowledge of consolidation. And then you have to attempt the IFRS portion separately. And then finally, you are required to prepare the balance sheet. So from the note, you can see that there is a 70% investment in the Spade Company. So parent company, that is Diamond, has acquired 70% stake in Spade Company. For a cash consideration of 1140 on 1st April 2016, the retained earnings and the other component of liquidity 780 and 64 million. The fair value of the identifiable asset is given to you, and you are required to calculate the basic level of goodwill. So it's a very basic adjustment of the consolidation. So all the information is given to you. All you need to do is to calculate the goodwill on the data given to you. The second part is relating to the Diamond acquired 40% shares on 1st April 2015. So you know it very well that on the 40% shares, you might not be able to control the Club Company for a cash consideration of 420. At this date, the carrying amount of the fair value of that identifiable net assets of the club was 1032. So all the information is already given to you in the question. Then Diamond took control of the Club Company by obtaining further 45% shares. So initially, Diamond has acquired 40% shares of the Club Company, and subsequently, Diamond has acquired further 45% shares. So the overall percentage will be 85. So it is actually the case of step acquisition. So previously the Club Company is our associate company, and subsequently it will become our subsidiary company. So from the date we got the control of the Club Company, we have to consolidate it, and previously it should be considered under equity method. So when we got 40% stake in this Club Company, you have to apply the accounting treatment of IAS 28, that is equity method. And when we got 100%, 85% control, when we got 85% shares, so actually we got the control of the subsidiary company Club. So from that date, we have to consolidate this company. For note number 3, the Diamond has owned 25% shares. You can see that it is actually an associate company, if I'm not wrong. In Herd, for a number of years, Herd had a profit for the year and at 31st March 2017 is 20 million, which can be assumed to have accrued evenly. Herd does not have any other comprehensive income. On 30 September 2016, Diamond sold 10%. So previously you got 25% shares in Diamond, Herd company, and you sold 10% shares. So it is actually the case of disposal. Diamond was unsure how to treat the disposal and so deducted the proceeds from the, I think we have to move a little bit down. Okay. Now, has deducted the proceeds from the carrying amount of the investment on 1st April 2016, which was 110. Calculated using the equity accounting method. So previously we got 25% shares in the Herd company, and at that time actually it was an associate. Therefore we are applying the equity accounting. And when we sold 10% of the investment, what we have done, the fair value of the 15% shareholding was estimated to be 65 million at 30th September 2016 and 67 million at 31st March 2017. Diamond no longer exercises the significant influence after the disposal, that is quite obvious, and has designated the remaining shareholding as the fair value through OCI. It means after the date of disposal, we have treated the remaining 15% investment under IFRS 9. So we are considering and treating the 15% remaining investment under IFRS 9. Then we have one of the information, that is goodwill has been reviewed for impairment. No impairment was has deemed necessary. These are the basic. We are just quickly reviewing the past papers so that we can start our working. So the next part is goodwill has been reviewed for impairment and no impairment was deemed necessary. So there is no need to do any sort of impairment testing. So for note number 5, now keep this point in mind. The first 3 notes are normally relating to the consolidation part, and the remaining 2 or 3 notes will be relating to IFRS part. So can you judge in note 5 which standard we should have to apply? Can you people please write your answers in the chat box, that what for which standard we have to use for the valuation or the treatment of note number 5. Yes, we have received some answers. Yes, you're very right. Note number 5 should be considered under IFRS 9. How we can see this? Diamond acquired 50 million 6% latest bond. So bond, listed bonds. Bonds are actually financial instruments. So it should be considered and measured under IFRS 9. Then we have note number 6. Diamonds operates a defined benefit pension scheme. From the name you can easily understand then that this portion should be considered under IS 19. So if you know the basic concept of IS 19, you can easily attempt this part. And finally, on 1st April, the Diamond acquired a manufacturing unit under a 8 years finance lease. Can you judge from which part of from which standard we have to solve this? From which standard we have to solve this? So yes, you can see that it's actually a lease related area which was previously considered under IS 17, but now it should be dealt with under IFRS 16. So IAS 17 is actually no longer applicable. So we have to apply this under IFRS 16. So it's very important for all of you to please do participate with me. Whenever I ask questions from you, please write your answer so that I can understand that the people are listening to me, uh, and you can easily you can ask any type of question for me if you wanted to. So this portion is relating to question number 1 and consolidation with some IFRSs. It is highly recommended that if you will not be able to understand note number 5, 6 or 7, just leave that note and attempt the consolidation question. The structure is something like this, that the consolidation part will give you approximately 20 marks, and the remaining 3 adjustment will give you 15 marks approximately. So if you ignore, for example, a particular adjustment like note number 7 and attempt a question, you can easily score 25 to 30 marks from this portion. So if you got 30% marks from this portion, then all you need is just 20 more marks to pass this exam. So it is very important that whenever you are confused in a particular adjustment in the examination, just leave that adjustment and try to attempt the remaining part. Don't get panic from the adjustment, and do not spoil your paper. So moving towards the next slide. These are section B, that is relating to factoring. And then we have question number 2 with 3 adjustments. Then we have question number 3 with 3 adjustments. And we have question number 4 with few adjustments. So our target is to attempt this past paper today, and we will be focusing on how to gain these 35 marks, and how to attempt question number 2, how to attempt question number 3, and how to attempt the questions of question number 4. So let's start and go through the presentation slide again. So moving on towards the next slide. So my recommendation for all of you is to break the question into different adjustments. Like, I just take the data from the question and just take the first adjustment from the question. So I'm giving you just 1 minute to solve this question and calculate the goodwill in Spade Company. The question says that the Diamond Company has acquired 70% shares in the Spade Company. It means the remaining NCI is just 30%. So for your convenience, I'm giving you the formula for the calculation of goodwill. The simple formula is cost of investment, then plus NCI at the acquisition. Then we have to deduct the fair value of net assets. So please calculate the goodwill from this formula and write your answers in the chat box. Please, I'm giving you just 1 minute. Okay, let's start. On 1st April 2016, 1st April 2016, that is called the date of acquisition. Diamond acquired 75% of the equity interest of Spade, paying the cash of 1140. So the cost of investment is 1140. So you can see in the investment side of the Spade Diamond Company, then the investment in Spade is actually 1140. And from this 1140, we got 70% shares of the equity instead of Spade paying by. Okay, on 1st April 2016, the retained earnings and the other component of equity of the Spade were 780 and 64 respectively. The fair value of the identifiable net asset of the Spade at the date of acquisition is 1600. So the fair value at the date of the fair value of net assets at the date of acquisition 1600, and the fair value of the NCI is 485 at the date of acquisition. So by adding these two and deducting 1600, we got the final value of 24 million. And as the question says that there is no impairment in the goodwill, so there will be no need to write impairment loss. But if the question says that there is an impairment, you have to deduct the impairment loss. So it is, I think it's very simple to attempt this question if you see the question in bits and pieces. So break the question into pieces and attempt just first part. Just focus on the first part and just ignore the rest of the part. So you will feel that this is quite a simple question of consolidation rather than when you see a complete question in just one go, you will feel that it will be very difficult or hard to attempt this question. So the basic approach is to break the question into pieces and try to attempt this question. Now, the fair value of net assets here is 1600, but the share capital of Spade is 720. The retained earnings at the date of acquisition is 780. And finally, the other component of equity is 64. So by adding these two, there will be a difference that should have to be shown here. That is, the excess in the fair value of the identifiable asset is due to a non-depreciable land. So there is a difference between these values, that is the book value of the net assets and the carrying fair value of the net assets, which will be considered as a revaluation in depreciation land portion, that is non-depreciable area. So can you please calculate the differential amount? I think it's 720. I don't have a calculator here, so I have to calculate on the cell phone. That is 720 plus 780 plus 64. The amount will be 1164 minus 1600. So there is a fair valuation adjustment of 36. But you do not have to worry about the excess depreciation adjustment of this part, because the adjustment, fair valuation adjustment, is relating to just land component. So all you need to do is to memorize this point, that whenever we are consolidating these three non-current assets, we have to add, what we have to add? 36. That is the revaluation of the land in the Spade's net assets. Okay, there is a question from the student side that where are 780 and 64 coming from? 78 and 64 is given in the question adjustment, that is here. These are the values of retained earnings and the other component of equity at the date of acquisition. So we pick these values rather than the retained earnings or the other component of equity at the reporting date. So for the calculation of the goodwill, you have to take all the values at the date of acquisition. Any other question from the student side? Yes, you can ask directly. Any other question, or should I have to move forward? I think I should have to move forward. So let's move towards the next slide. So we just come to know that the goodwill in the Spade company is 25. Now we have another challenging question for you that is relating to the step acquisition. The formula for the goodwill in case of step acquisition is that you have to take the cost of investment and we have to take the fair value of the investment retained. That is the previous investment that we have previously. So you have to take the value after which we got the control of this subsidiary company, that is club, and we have to take the fair value of the previous investment, and then finally we have to add NCI, and after that we have to deduct the fair value of net assets. So in this question I am giving you just 2 minutes to solve this question and calculate the goodwill. So for your convenience I have write down the formula for the goodwill. So all of you are required to just solve and input the data in this formula and format and calculate the goodwill in the value of in club company. So for the sake of simplicity I have removed the Spade from the between diamond and club, and I just show only diamond and club. So this is the way that you should have to look when you are attempting the consolidation question. When you are focusing on the club company, just ignore the Spade and focusing on just diamond and Spade club company. So here we have an adjustment 2 for you. Please solve this question and calculate the value of the goodwill. Okay, there is a question from the student side that how we can identify that it is a full goodwill method or a partial goodwill. So here you can see that the fair value of the original 40% holding and the fair value of the non-controlling interest. So if we are taking the fair value of the non-controlling interest, then it means it's a full goodwill approach rather than proportionate. So whenever examiner is going to ask partial or proportionate goodwill approach, examiner will tell you that the NCI will be based on the proportionate share of net assets. So the terms of the question or the wording in the question will be like the NCI should be calculated at the fair value of the proportionate share. So these are the terms that the examiner will use. Okay. So there are a few questions from the student side. Is that please repeat the proportionate goodwill point. Okay. Examiner can ask the questions. Sometimes examiner can ask the question from the proportionate goodwill approach, or sometimes examiner can ask the question from the fair value or the full goodwill approach. So the key point to memorize is that if the question says you that the NCI should be calculated on the fair value of the non-controlling interest, you can see here, if the question says you the NCI should be calculated at the fair value of the non-controlling interest, then it means the requirement is to calculate the full goodwill. But if the question says you that the NCI should be calculated at the proportionate share of net assets, then it should be on the proportionate basis. So I'm going to solve this part of the question. So previously we got 40% shares for a cash consideration of 420. That this value is totally irrelevant because we have to take the fair value of the previous investment. At that date, the carrying amount and the fair value of the identifiable assets of the club was 1032 million. Diamond treated the club as an associate and the equity matter for the club up to 31st March 2016. On 1st April 2016, Diamond took control of the club, acquiring further 45% shares. So for the 45% shares, Diamond Company has paid 500 million and added this to the carrying amount of this investment in the club. On 1st April 2016, the retained earnings and the other component of equity of the club were 293 and 59 million respectively. And the fair value of the identifiable asset is 1062. So when the parent company acquired the control of the subsidiary company, the fair value of the net assets will be at that date, that is 1062. And there is a hint in the question that the share price of the Diamond and the club are 5 and 1.6 respectively. So the fair value of the original 40% holding and the fair value of the non-controlling interest should be both estimated using the market value of the shares. So the 40% value and the 15% NCI value should be based on the market price of the company. So how we can calculate the fair value of the previous investment, that is 40%. So previously you can see here that the company has a total share capital of 700. So out of 700, company has acquired 700. Company has acquired 40% investment, and for each share the market value is now 1.6. So by multiplying these values, we got the final answer of, please calculate the values and reply me your answer. That is 700 into 40%, 0.4 into 1.6. The final value is 448. So actually the final value is 448. Yes, very good. And what about the NCI? So out of 700, the NCI share is 15%, and for each share we have the share price is 1.6. So what should be the final value? So it should be 700 into 0.15 into 1.6. So the amount will be 168. So the amount of the final goodwill should be 500 plus 448 plus 168 minus 1062. So the final amount of the goodwill should be 54. Now I'm here for the question answer sessions. If you have any question, please do ask him immediately so that we can discuss your queries and questions and we can move on or forward. So if you have any question, please do ask. Can't see the questions here. Where is the 15% comes from? Okay, 15%. You can see here that previously parent company has acquired 40% shares on 1st April 2015, and on 1st April 2016 parent company has acquired further 45% shares. So the total investment of the parent in the club is 85%. So the remaining portion will be considered as the share of NCI. So this is how we have calculated the 15% value for the NCI. Okay, there is a question that may I know why not to take 420 of the cost of investment for the fair value of net assets? Not 1062. I didn't get you. May I know why not take 420 of the cost of investment? Okay. Why we didn't take the 420 for the cost of investment is that because the investment value that is given to you is at 1st April 2015, and according to IFRS 3 it says that whenever parent company acquires control of the subsidiary company, so at that date you have to take the fair values of net assets and the investments at the date when the parent acquired the control of the subsidiary. So the main thing is that whether we will be able to control the subsidiary on 1st April 2015, the answer is no. We can only control the company from 1st April 2016. So you have to take the values of all the investment and the net assets on 1st April 2016. That's why we ignore the value of 420 and take the value that is adjusted, which is 448. Okay. Why we are taking 15% and 40% in the calculation? 40% is before the step acquisition. Why we are taking 15%? Actually, we are consolidating from 1st April 2016 rather than 1st April 2015. So we are calculating the goodwill on 1st April 2016. Therefore, we have taken all the values at 40%, 45%, and 15%. Okay, treatment of gains and losses and the previous investment on the club. Just wait for the previous investment where the numbers come from. I can see where the numbers come from, but it is still confusing. I'm not confident that I will identify the right amount in the exams. I'm completely messed up in a question like this when I took the exams before. Okay, so don't be confused, my friend. Just follow my recommendation, and that is whenever parent is able to control the subsidiaries, so mark that date and take all the values for that date. So in this question you can see that the parent took the control on 1st April. Here you can say that is 1st April 2016. So you have to take all the values with reference to 1st April 2016. So ignore all the values before and after 1st April 2016. Just focus on this date, that is 1st April 2016. Okay, what happens if it was acquired in the year? Acquired in the year, do we take it all? You have to adjust the values if the acquisition was made at the mid of the year. So the key point again is that the consolidation should start from the date when parent company gains the control of the subsidiary company. So all you need to do is to focus on the date of acquisition, is the date at which parent acquires the control of the subsidiary. So if the information is not given to you at that date, so you have to adjust all the values according to the date of acquisition. Other question is, what will happen between the difference between 448 and 928 in the balance sheet? Is it with the fair value increase? Someone is asking about the 928 value. I think it's 928. Yes. The information given to you is that is 928. So the 928 is actually the breakup of 420 and the new investment, that is 5 for 500. Yes. Plus the adjustment of 8. Because previously the investment will be considered under equity method, so we have to adjust the 8 amount. I'm just telling you a few minutes after how we can calculate the value of 8. But my question is that if you have any confusion in the calculation of goodwill, you can ask it immediately. Otherwise, I will move on to the next part of this question. Why didn't you take 59 million value for equity? Where is the 59 million? Okay. Because we have been already given 1062 value, that is the fair value of net asset for the calculation of the goodwill. If the fair value is already given to you, you are not required to take the individual values. So if the examiner has already given to you the fair value of that asset, just take it all the values. This value is only given to you to calculate the fair valuation adjustment. So we can easily calculate the value of the goodwill from this data. Now we are moving towards I think we have to so the next part is previously the investment was actually an associate company. Previously the investment was actually an associate company on 1st April 2015. So the cost of the investment at the date of acquisition of the associate is 420. So what are the requirements? So in case of step acquisition, all you need to do is to calculate the gain or loss on derecognition, because we are going to derecognize the associate and we are going to recognize the subsidiary in the books of accounts. So for the derecognition of associate company, you are required to calculate the gains and losses. So the formula will be, that is the fair value of the investment less the carrying amount of the investment. So please calculate the gain or loss on the derecognition of the associate company, and the formula is written on the slide, that is gain or loss is equals to fair value of the investment less the carrying amount of the investment. So please calculate the gain or loss on the derecognition. The fair value of the investment is now 448 actually. All of you are required to just calculate the carrying amount of the investment. So when the parent company obtained the significant influence in the associate company on 1st April 2015, the fair value of net asset at that date was 1032. Okay, and parent company further acquired the shares in the subsidiary company on 1st April 2016, that is additional 45%. So at this date we have to calculate the net assets in total. So the net assets at this date will be 700 share capital, that is mentioned here. The retained earnings value is now 293 plus the other component of equity is now 59. So what is the incremental difference between the net assets? So the incremental difference is now 700 plus 293 plus 59. We got the final value of 1052. So at the date of acquisition, we have got the net assets of 1052, and now we got the value of from 1032 to 1052. So there will be an incremental change of 1052 minus 1032. That is called the share of post-acquisition profit, in which parent company has got 40% shares in the associate, and 20 into 40%, we got the value of 8. So the total value up till the date when parent excuse me, acquire the control of the subsidiary is 428. So the carrying amount of investment at 31st March 2016 is 428 and its fair value is 448. So there is a gain of 20 that we should have to recognize in the consolidated retained earnings. So please understand this point, that this gain should be recognized in consolidated retained earnings. So if you have any question about this gain, a loss of derecognition, you can ask it immediately. If you have any question, please do ask. Okay, repeat. Okay, for your assistance, I can tell you that ACCA team will send you the lecture videos on daily basis. You can see my videos a number of times, and it is not possible for me to repeat the question and the formula again and again. So I'm repeating it right now, but for your assistance, ACCA team will provide you the videos of all the lectures. You can see my videos to get the understanding of these core concepts. So I'm repeating it again, that at the date of acquisition of associate company, the fair value of net assets is 1032, and at the reporting date, or you can say at 1st April 2016, the net asset value is now, this value is for 2016. This is how we have calculated. The share capital is given to us, that is 700, retained earning is 293, and OCI is 59. So by adding these three values, we got the total net asset worth of club company on 1st April 2016, that is 1052. And previously the total net assets is 1032. So there is an incremental difference in the post acquisition period. post-acquisition period for the associate only actually. So there is an incremental difference in the post-acquisition period is 20, in which we got 40% shares. So after the acquisition, there is an incremental share of associate is 8. So this is actually the share of associate in club company. So before de-recognizing, the carrying amount is now 428 and the fair value is what we have already calculated, the goodwill, that is 448. The difference will be considered as a goodwill. Okay, what about 1062 fair value given in the question? The 1062 amount given in the question will be used for the calculation of goodwill. We never measure the value of the associate on the basis of the fair value of net assets. We just take the value of associate at the fair value of at the carrying amount of the net assets at the reporting date. So moving towards the next slide. So we have to okay, one more important point here is that the difference between the carrying amount, that is now 1052 and the fair value of net assets, that is 1062. So the difference between the carrying amount and the difference between the fair value of net assets was related to the plant actually. So actually when parent acquires the control of the subsidiary, there is a fair valuation adjustment of the plant, which is 10 million, and at the same time the remaining useful life is now 5 years. Now it means that you have to make the adjustment of excess depreciation as well for this plant. So from 1st April 2016 to 31st March 2017, there is a time period of 1 year. So the excess depreciation amount will be 10 million upon 5. The adjustment will be 2. So there is a fair valuation adjustment between the book carrying amount of the net assets and its fair value. Which is from 1052 to 1062. So there will be a difference of 10, which should be considered as a fair valuation adjustment. And we have to take the excess depreciation of by deducting by dividing 10 upon 5, that is the remaining useful life. So there will be an excess depreciation adjustment of 2 million. So let's move on to the next slide. If you have any question, please do ask immediately. Otherwise, we have to move towards the next slide. So now, then we have the next part of this question, that is relating to the associate. Previously, we have got the associate company for a number of years. I think I have to change the color of the pen. We have got the associate company for a number of years. Hard had made a profit for the year to 31st March 2017 of 20 million, which can be assumed to have accrued evenly. Hard does not have any other comprehensive income on 30th September 2016. So the financial year starts on 1st April 2016 and it ends on 31st March 2017. So the profit for this period is 20 million actually. Okay, HAR does not have any other comprehensive income on 30th September 2016. 30th September 2016 means at the mid of the year. Diamond sold 10% of the equity interest for a cash consideration of 42. So previously we have got 25% shares in Herd company, and after the disposal there will be a remaining percentage of 15%. So previously for the first 6 months you have to follow the equity accounting, and after that you have to follow the requirements of IFRS 9. The Diamond was unsure how to treat the disposal and so deducted the proceeds from the carrying amount of the investment at 1st April 2016, which was 110 million, calculated using the equity accounting method. The fair value of the remaining 15% shareholding was estimated to be 65. This is what the fair value of the 15% investment, and 67 million on 31st March 2017. Diamond no longer exercises significant influence and has designated the remaining shareholding as a fair value through OCI. So for the last 6 months, all the gains and losses will be recognized in OCI. So I'm giving you just 1 minute to solve this note by yourself, and we will solve it together after just 1 minute. So please solve this question for 1 minute. There is a question that where do we post the 20 million D recognition in the associate? So there is no need to, because we have already sold the associate company. So there is no need to adjust the 20 million. The 20 million amount will be recognized in retained earnings only. Where do we got the 1052 value? We just add the share capital amount, retained earnings, and other component of equity amount in the note. This is how we have calculated 1052. Where is these slides? Which slide? So please solve this question so that we can start. I'm giving just 1 minute to solve. Okay, there are the slides are different from. There's a complaint from the student that the slides are different from what we are discussing. So can you give me just 1 minute so that I request the management to upload the relevant slides? Okay, there's a question that said we only treat the investment as an associate if we are making a consolidated financial statements. Actually, when we are preparing the balance sheet, from the balance sheet perspective, we are preparing the balance sheet at the reporting date, and at the reporting date we don't have any associate company. So there is no need to show the associate in the consolidated balance sheet. But as far as the income statement is concerned, you have to adjust the share of profit of associate up till the date when we have sold the associate share, and after that we have to take the gain or loss according to the requirements of IFRS 9. What we are trying to do, I find it just confusing. Okay. So let's start. Diamond has owned 25% shares. So Diamond has owned 25% shares in Herd company. Herd had made a profit for the year ended 31st March for 20 million. So there is a profit of 20 million for the year. For the first 6 months, the profit will be 10 million, and for the last 6 months, the profit will be 10 million, because it shows that it has been accrued evenly. So in the first 6 months, we got 25% shares in associate, and the value will be 2.5 for the first 6 months. Okay. So you have to take the share of associate profit for the first 6 months only, because there will be no significant influence after the first 6 months. Diamond sold a 10% equity interest for a cash of 10 million, 42 million. So we are going to calculate the gain or loss on the disposal actually. So first we have to take the cash investment, the cash that we have received for the disposal of this investment, that is 42 million. Okay. Then we have to add the fair value of the investment retained. The investment that we have retained, previously we got 25% investment, and after the disposal the remaining investment is now 15%. So the question says that the remaining 15% shareholding was estimated to be 65 million. So the fair value of the remaining investment is now 65 million, and we are required to deduct the investment in associate. The carrying amount of the investment on 1st April 2016 is 110 million. The carrying amount of the investment is 110 million, but we haven't sold the investment on 1st April 2016. We sold the investment on actually 30th September 2016. So we have to adjust the carrying amount with the additional profit of 2.5. This is what we have calculated here. So at the date of disposal, the carrying amount of the investment associate is now 112.5. So there will be a gain or loss on disposal. So the loss on disposal will be 5.5 negative. This amount should also be shown as an adjustment in the retained earnings. So what about the rest of the 15% part? Now we have to deal the 15% investment under IFRS 9. That is, it should be classified under fair value through OCI. So the investment with a value of 65 million has now worth 67 million. So there is a gain of 2 million which should be shown in OCI. So just remember these all points. So I have selected this paper because we have got the flavor of the basic goodwill calculation. We got the basic flavor of acquisition, and we got the basic flavor of disposal, and how to calculate the gain or loss in disposal, and how to calculate the goodwill in case of step acquisition, and how to treat the investment that was previously not controlled by the parent, and now the parent got the control, that is called a step acquisition. So these are the adjustments for consolidation. So there is a question that can we have a WhatsApp group to facilitate the doubts? Okay, for your assistance, I am available all the time. You can ask any type of questions directly to me, and my cell number is 0092. That is 3322. Sorry, 3322134466. So this is my cell number. You can contact me, you can email me, or you can send me any type of question or a snapshot of the question, and we can have a discussion on the WhatsApp group, or you can just message me. I will build a WhatsApp group if you wanted to discuss the issues with you. So a gain of 2 million will be posted in OCI, should be posted in the retained earnings. Am I right? No. The OCI component will be adjusted in the other component of equity actually. The OCI component should be adjusted in the other component of equity. Can you please explain the 2.5 million? 2.5 million is actually the share of the investment of the parent company in the associate company for the first 6 months, because after the first 6 months we have sold the associate investment by 10%. So for the first 6 months the profit of the associate is just 10 million and our share is 25%. So the share of associate profit is 2.5. So why we not use the 68 instead of 110? Why we not use the 68 instead of, actually 68, where we have 68 million? I don't see 68 million. Why we not use 68 instead of 110? Can you repeat your question? Okay, what is my email address? My email address is HAMMAD, that is Hamad, HAMMAD, server 262 @gmail. This is the email address of mine for students. So if you wanted to ask anything about this session or anything about the paper P2, you can ask it immediately direct on this email or my cell number, that is 0092 3322 134466. So what should be the adjustment? There is a loss of 5.5 that should have to be shown in retained earnings. Secondly, there is a financial asset that should have to be reported in the balance sheet at 67 million, and in OCI adjustments will be made in OCE actually, that is other component of equity. So there will be a gain of 2 million in OCE. So these are the basic areas of the consolidation. Now we are moving towards the next part of the slide. And now this part is now relating to uh, a particular standard, and we have already guessed that this one is relating to IFRS 9. So all of you are required to attempt this question and make the necessary adjustments as per the requirements of IFRS 9. So I'm giving you just 1 minute to try to attempt this question, assuming that this has appeared in the examination. So what should be your approach? And try to attempt this question. I'm giving you 1 minute, then we will start discussing this question. So you have 1 minute to attempt this question. Sorry, there's a funny noise. So we balance sheet, how we can treat the OCI gain 2 million under IFRS 9. We are balance sheet. We can treat the OCI gain of 2 million under IFRS 9. In the balance sheet, we have to report the 2 million in other component of equity section rather than retained earnings. Are you going to be solving the past papers today? Yes, we'll be focusing on the past papers today for day 1, 2 and 3, and in day 4 and 5 we'll be having IFRS 16. Then we will be discussing IFRS 13, IFRS 9, and if the time allows, we'll be discussing some of the major concepts of financial instruments. So let's start. Diamond acquired 50 million 6% bonds. 50 million 6% bonds means it's actually a financial asset. Having a rate of 6%. At the nominal value, the Diamond may sell or hold the bonds to maturity. So what are the requirements of financial assets under IFRS 9? If the instrument is a debt instrument. So IFRS 9 says that if the instrument is debt instrument, you can measure it at amortized cost. You can measure it at fair value through OCI, and you can place it at fair value through P&L. So what are the requirements to place the financial asset debt instrument under amortized cost? So the debt instrument should have to pass the business model test and the cash flow test. And at the same time, for the fair value through OCI category, the debt should have to pass both the business model and the cash flow test. So if the debt instrument will be able to pass the test, it will be considered under amortized cost, and if it passes the test of OCI, it should be considered under fair value through OCI. All other remaining debt instruments should be classified under fair value through P&L category. So these are the requirements of IFRS 9 actually. So for the business model test, the test will be passed if the intention is to hold the investment up to the maturity. So if the intention is to hold the debt instrument up till the maturity date, then you can say that the business model test is passed. And cash flow test will be passed if the cash flows will be based on the interest component and the principal component. So if these two tests are passed, then it should be classified at amortized cost category. And at the same time, business model test and cash flow test. The business model test of the fair value through OCI category is little bit different from amortized cost, and it is if the intention is to hold and sell. If the intention is to hold and sell subsequently, then it should be classified under OCI. The cash flow test of both the models are same. So here you can see that the diamond may sell or hold the bonds to maturity. Therefore, it should be classified into this category, that is fair value through OCI. So based on this, business model has designated bonds as the fair value through OCI. So you can see here it is in compliance with the requirements of IFRS 9. So the effective rate of the interest of the bond is also 6%. The bond had a fair value of 42 million at 31st March 2016 and were correctly treated in the financial statements of that date. On 31st March, that is the year end 2017, Diamond received the coupon interest of 3 million, which was recorded within the interest received section, and then sold the bond on the same day for 35 million. The disposal proceeds were substantially below the fair value. So here is a hint for you, which was 38 million. A 7 million loss on the disposal was charged against the profit and loss. Diamond has an option to repurchase the bonds at any time to 31st December 2018 for 36 million. So this is again a very important point, that if you have the right to repurchase the bond at the subsequent date, it means the risk and reward of the asset has not been transferred. So whenever the risk and reward has not been transferred to the buyer, then you cannot de-recognize the financial asset. So the key point is that in this case, you cannot de-recognize the financial asset. Secondly, that the bond has an option to repurchase the bond at any time up to 31st December. The fair value is expected to increase in the future, and it is highly likely that the Diamond will exercise this option. So the fair value is very low. It means there is a huge chances that the Diamond company will repurchase the bonds subsequent to the disposal. So it means the risk and reward of the financial asset has not been transferred to the buyer. So now we are going to adjust this in the financial statement. So what will be the impact of this on the financial statements? think I have to insert a slide to solve this portion. So initially the investment has a value of 50 million, and after some time the value has gone to 42 million. So the interest rate is 6% and the effective rate is also 6%. So the interest and effective both values will be 3 million. So the financial asset at the start of the period is 42 million. Then we have to book an interest income, that is 3 million, and then we have to book the receipt of the interest, that is 3 million, and we got the value of the financial asset at the end, that is 42. And in the current year the value is now at 38. So there is a loss on the financial asset fair valuation adjustment, that is 4 million. So the adjustment will be financial asset should have to be debited by 38 because company has de-recognized the financial asset. So we have to rebook it at 38 million. Then we have to reverse the loss that we have already charged in the retained earnings, which is 7 million. And we have to book a liability of 5 million. So this should be on the debit side and it should be credited. And we have to book the loss on the disposal in OCI, that is 4 million. So this is actually the impact of this adjustment. Please note down this adjustment. And there's a question that can you please repeat? Okay. Actually what the company has done, company has recorded this event by debiting the cash and crediting the value of the investment. The company has credited the value of the investment with 38 million, and the investment was sold. I have to go back. The investment was sold at a value of 38 million. Okay. So the cash that we have received is 38 million and we have recognized the loss on the disposal, that is 7 million. So we have credited the value of investment with 45. A 7 million loss on disposal was charged against the profits. You can see here that the loss on the disposal was charged in the profit and loss statement. And the bond had a fair value of 42 million. This is what you can see here, that there is a fair value of 42 million on the value of the bond. And Diamond received an interest of 3 million, which was recorded in the interest received. So there is no need to adjust the interest received, and then sold the bond on the same day for 35 million. So we have sold the bond with the value of 35 million. So there is a loss on disposal, that is 42 minus 35, that is 7 million. So I think we have made a wrong entry here. So the amount that we have received for the bond is 42 and received the value of 35. This is actually the adjustment that the company has already made. So you cannot actually recognize the loss on the disposal of this investment with the value of 42 million and you have sold it for 35 million. You cannot actually de-recognize the investment, that is 42, and you cannot book this loss according to IFRS 9. So what you are required to do is to reverse the investment at its fair value, which is now 38 million, number one. Then the cash of 35 million will be considered as a loan because we at any time we can repurchase. So when the risk and rewards of the investment is not being transferred to the buyer, so we cannot de-recognize the financial asset. Instead, we have to book a loan that is equal to the value that we have received. So the accounting entry should be cash debit and loan credit 35. This should be the right accounting entry for this adjustment. And company has made the entry by debiting the cash 35, crediting the investment by 42 and recognize a loss. You cannot book the gain or loss on disposal unless the risk and rewards of ownership has been transferred from the seller to the buyer. So what I have done, I have reversed the value of the investment with the value is 38 now. Then what I have done, I have reversed the loss that we have previously recognized by crediting the retained earnings. Then I have booked the liability, that is 35, and there is an amount of 4 million that should have to be recognized in OCI. So these are the adjustments and these are the workings. OCE, other common of equity. So I'm giving you just one more minute to just repeat this adjustment and try to understand this concept. So if you have any question, please do ask. So the 4 million is the balance only. 4 million is actually the loss that we have made when we booked the investment from 42 to 38. So there is a loss on the value of the investment that should have to be reported in OCI. OCE actually. OCE. So here we have another adjustment, but the most important part that you should have to understand is that for adjustments like we have seen in note number 5, 6 and 7, these adjustments will not going to impact NCI or goodwill because examiner will always give you these adjustments in an isolated manner. So it will only affect retained earnings at maximum or assets or some component of the liability. So it is very easy to adjust these adjustments because it is not going to affect your goodwill and it will never affect the NCI. So these are actually the investments of the parent company or the adjustment relating to the parent company. So it will never affect NCI and the goodwill. So it is very easy to incorporate these even at the end of the question when you prepare the full balance sheet, and you can adjust it at the same time. So can I have the special lesson for the financial instruments? Okay, financial instruments, it depends on the requirements. If you have any other requirement uh, related to any other topic you wanted to study, we can extend the session 1 day or two. I have a plan to discuss the past papers in which we will cover the most important areas of IFRS which can be examinable in December session. And at the same time, I'll be covering IFRS 16, IFRS 15, and IFRS 13. I think these are important and relevant for this session. But if you have any confusion in these and any other standards, you can ask me directly. I can send you the basic slides, or we can conduct an extended session for IFRS like this. So, moving on. So, can I have the special lesson? Okay. Why will we keep the recognizing the finance? Why we will be keeping? Okay, why we are still recognizing the financial asset? Because we have not yet transferred the risk and rewards of the financial asset to the third party. So still, because we have the right to repurchase the asset, which is substantially lower than the fair value, and it is highly probable that the company will exercise this right, it means the risk and reward is still rest with the company. Therefore, we are still recognizing the financial asset, but the value is slightly lower than previous. That is now 38 million. So moving towards the next slide. Diamond operates a defined pension scheme on 31st March 2017. Pension means it is relating to IAS 19, that is from employee benefit. The company announces that it has closed down a business division and agreed to pay each of its 150 cash payment staff a cash payment of 50,000 to compensate them for the loss of the pension arising from the wages inflation. It is estimated that the closure will reduce the present value of the pension obligation by 5.8 million. Diamond is unsure of how to deal with the settlement and curtailment. So this portion is actually related to a specific part of IAS 19, that is curtailment and settlement. So let's have a quick review of this part, that is curtailment and settlement. So let's start. So let's discuss this slide first. For the curtailment and settlement, we can have with settlement approach or without settlement approach. With settlement and without settlement, and what is the meaning of the curtailment? If the company is running a defined benefit pension scheme and after some time the company is going to discontinue that scheme, so this is called curtailment, and the curtailment could be with settlement or without settlement. With settlement means that we are going to pay some amount to compensate the employees, or without settlement means that we are not going to compensate the employees for the discontinuation of employee benefits. So I think I have not selected this. Not working actually. It's not working. Yes, with settlement and without settlement. Yes. Overpaid, underpaid, or this is now the complete slide. Now, if we are going to approach the without settlement approach, the whole amount of the defined benefit obligation should be debited and the gain on the curtailment, because we are not going to settle the employees for the obligation that we have already incurred. So the whole amount of the gain should be recognized in the retained earnings. But if we are going to settle the amount, it could be overpayment or underpayment from the plan assets. So if there is a overpayment from the plan assets, then the difference will be recognized as a loss. And if there is some underpayment in the plan assets, then the difference will be recognized as a gain. So assuming we have got a defined benefit obligation of net obligation means asset minus liability of 100 million, and we are going to pay the cash of 120 million. So there will be a loss on the settlement of 20 million. So sometimes we pay the over amount, or sometimes we pay the lower amount than the defined benefit obligation. So now we are moving towards the basic part again. So I'm giving you just 1 minute to solve this part, so we can start the question. I'm giving just 1 minute. Please try to solve this question by yourself. I'm having a coffee with me. Please write your answers in the chat box. Whether there is a gain or loss on disposal on the curtailment. Please write your answers in the chat box whether there is a gain or loss on there is a loss in settlement. Loss. The defined benefit obligation is 5.8. That is actually the net obligation. It should be debited, and we are going to pay 50,000 per employee, and we have got 150 employees. So the amount of the settlement will be cash credit by 7.5 million. Okay, the company agrees to pay. So it means we have not yet paid the cash. It will be recognized as a current liability. So there is a loss of 7.5 minus 5.8. So there is a loss of 1.7 that should have to be recognized. So what are the adjustments that you have to do for the consolidation purpose? In the current liability, you have to add 7.5 million. In the non-current liability, there will be a defined benefit obligation. So you have to deduct 5.8 million from the non-current liability, and the loss of 1.7 million will be recognized in the retained earnings. So there's someone is saying there is a gain on the curtailment. Actually, there is no gain on curtailment because we are going to pay more amount than we have booked the liability in the balance sheet. So previously we have booked the liability of 5.8, but we are going to pay 7.5 million for 5.8 million liability. So there is actually a loss on the settlement and curtailment, and the loss on the curtailment settlement will be recognized in retained earnings. So we have completed the note number 6 successfully, and now we are moving towards note number 7. Now here is a question for you. I'm giving you just 1 minute to solve this question by your approach. Then we will collectively start to solve this. Please write your answers in the chat box. Please write your answers in the chat box. I'm waiting for the answers. Okay, let's start this portion. On 1st April 2016, okay, let's start. Diamond acquired manufactured units under an 8 years finance lease. The lease rental have been recorded correctly in the financial statements of Diamond. However, Diamond could not operate effectively from the units until the alteration to its structure costing 6.6 million were completed. The manufacturing unit was, so 6.6 million is the amount that you should have to recognize under the asset. We are actually the lessee, and now according to IFRS 16 we have to book the right to use the asset. So the asset should be debited by 6 million. The manufacturing unit was all ready for use on 31st March 2017. Alteration cost 6.6 million were charged to administration expense. So it should be reversed from administration expense. So we have to credit the amount in the retained earnings, that should be 6.6 million. This is the accounting entry for this part. The lease required Diamond to restore the unit to its original condition at the end of the lease term. The Diamond estimated that it will cost further 5 million. So there is a future value which should have to be recorded at the present value. So the formula will be future value into the discount factor. So the value is 0.5. So 5 million into, for the 7th year, for the 7th year, the present value is 0.625, 627. So what should be the right amount for this? Please calculate the amount. Okay, right now we are at 31st March 2017. It means we have to take the discount rate of 0.665. It should be 0.665. So the present value should be 3.3 million. So the accounting entry should be right to use the asset debit by 3.3 and provision credit by 3.3. This amount should also be recognized in non-current liability. So this is actually the accounting treatment. If you have any question, please do ask. How did you calculate the 7 years? Actually, right now the manufacturing was ready for use on 31st March. So we have adjusted the structure on 31st March 2007. So from 1st April to 31st March 2007, there is a time period of 1 year, and from 1 year the remaining time period will remain. The remaining time period is just 7 years, because the lease period is for 8 years, and we have adjusted the construction contract. We have adjusted, the structure after 1 year. So 1 year is already spent. So the remaining time period is now 7 years. Therefore, we have, why 6.6 is recorded in retained earnings? Because we have to capitalize the amount, that is 6.6 million, and company by mistake has charged the amount in the administration expense. So in the administration expense means the company has recognized the amount in profit and loss statement and retained earnings. So the retained earning is debited actually when we charge the amount in the administration expense. So by reversing this adjustment, we have to credit the retained earnings and debit the right to use the asset. What is the requirement of in this question? It is actually the part of the consolidation questions, and you are required to adjust this adjustment in the consolidated financial statements. So the adjustment should be right to use the asset. Right to use the asset should be debited by 6.6 plus 3.3. Non-current liability should be adjusted with 3.3 million, and there is an adjustment in the value of the retained earning. It should be adjusted by 6.6 million. So these are the adjustments that we should have to made in the consolidated financial statement. So I have covered all the aspects of the question. So now it's your assignment. Please do cooperate with me. I will definitely improve your overall grip on P2, and I will ensure that definitely, inshallah, you all will pass this exam if you cooperate and follow my directions. So the key point is that all of you are required, as we have discussed already, all the adjustments, all of you are required to prepare the balance sheet for the question diamond, incorporating all these adjustments and all these workings, and try to make the balance sheet balanced. And if you have any query or issues, you can contact me on the on my email address, or you can contact me on the WhatsApp, or even you can contact me on day 2 session. Are you assuming that we are getting statement of financial position is what is coming out in the December exams? We are getting statement of financial position. So the debit lease and credit the admin expense for 6 months. Actually, we cannot credit the admin expense because we are not preparing income statement right now. We are here for the balance sheet, so we have to book the administration impact on the retained earnings actually. So arrange a WhatsApp group for further discussion. Yes, I'm going to arrange the WhatsApp group tonight, and we'll add all of you in the session. So you can just message me on the number which I have provided to you. Any other question for this part? So now we are moving towards the next slide. So here is a question for all of you. So I'm giving you just 1 minute to read the question and write the standard which is used to solve this question in the chat box. Please write the name of the standard that from your understanding that should have to be used to solve this question. So one of the answer that I have received is IAS 16. Please read the scenario carefully, and one of the answer is IAS 40. So I'm giving you just 1 minute. Please read the scenario, and because it is a big challenge for all the students to identify for which standard or from which standard we have to solve the adjustments, or which standard is applicable to a particular adjustment. So it is very important for all of you to understand the basic theme that which standard is applicable for this part of the question. There are a few students who are giving the feedback about IAS 40. So I want, it's my request to all of you to please do participate in the question answer session and tell me about what's your opinion about this question. There are some students who are telling me about IAS 40 financial instruments, both investment property. So we have received number of different feedbacks from the students. IFRS 9, IS 16, 40, and okay, let's start. To identify which standard is applicable in the scenario, examiner can give you the dodging in the scenario. So you have to be very careful what the question is, what information is given to you, and what the examiner wants from the scenario. On 1st March 2014, Cantu acquired a property for 15 million. So whenever you see the word property, it means it might be an investment property that is for IS 40, and it might be an owner's occupied property, and we have to apply IS 16 for that, which was used as an office building. So now it is confirmed that the property is used by the owner as an owner's occupied property, and so we have to use IS 16 for that. But Cantu measures the property on the cost basis in property, plant and equipment. Now the examiner has given you the final confirmation that IS 16 should be used. Or the company is already using IS 16 for the valuation of this property. The useful life of the building was estimated at 30 years. So this information is given to you for the calculation of depreciation and no residual value. Depreciation is charged on a straight line basis. Now again, a very useful and simple information about the depreciable asset. At acquisition, the value of the land content of the property was thought to be immaterial. Now here is the important point. Initially, the value of the land is immaterial. During the financial year to 28 February 2017, the planning authorities approved the land to build industrial units. So now you have the option to use your site as an industrial units and retail outlets. So you can use your property for rental purpose and make the industrial units and rent it out to different industrial companies. During 2017, Cantu ceased using the property as an office. Now the property is going to be changed from owners occupied to investment property. So there is no indication of IS 16 here. Examiner is more focused towards IS 40 actually. Cantu also builds retail units on the land during the year to 28 February 2017. At 28 February 2017, Cantu wishes to transfer the property. Now the property is being transferred from IS 16 to IS 40. That is very important. Common investment property at 20 million. This valuation was based upon similar properties owned by the Cantu. Similar properties. So the value of this property is being derived from the similar property. That means there is an indication of IFRS 13. As you know that IFRS 13 has given us hierarchy level of input level 1, input level 2 and input level 3. So you can use input level 1 means the quoted price for a particular item. Input level 2 is used when we calculate the fair value with the fair value of similar properties like we have used here. So the company is using actually input level 2, sorry. However, if the whole site was sold including the retail outlet, it is estimated the value of the industrial unit would be 25 million. Now, right now company is valuing it at 20 million. But if the company is going to sell all the property, it will receive overall 25 million because of the synergies and the complementary cash flows. The director of Cantu wishes to know whether the fair valuation of the investment property is in line with the international IFRS. So the basic concept here is how to calculate the fair value, which is the requirement of IFRS 13. So actually the basic concept here is to apply the provision of IFRS 13 to calculate the fair value of this property and how to account for the changes in the property in the financial statement. Changes means that the property is being shifted from IAS 16 to IAS 40. So my question is that whether this property should be shown at 20 million or 25 million. Whether this property should be shown at 20 million or 25 million. What is your answer about this? Please write your answers in the chat box. Whether this property should be shown at 20 million or 25 million. We have received few answers from the students that some people are saying that it should be valued at 20 million and some are saying that it should be valued at 25 million. So we have received both the answers of 20 million and 25 million. But what is the right answer? For the right answer, we have to understand the basic requirements of IAS 40 and IFRS 13. Okay. Now what IFRS 13 says about this transaction? IFRS 13 says that the fair value measurement of a non-financial asset. Non-financial asset means like property and something like that. Takes into account a market participant's ability to generate economic benefit by using the asset at its highest and best value. So we have to take the highest and best use. So where we got the maximum benefit from the use of the property will be used for the calculation of fair value. So if we have two options, one is to use the property for a particular reason and to use the property for another particular reason, then we have to use the value for the best and the highest use. So we have the option to use the building as an office and use it as an industrial units, and we have the option to sell the whole of the property. And because of the synergy effect, there will be a total value that we have received will be 25 million. So for this purpose, we have to value this investment property at 25, because the best use and the highest use value will be used for the fair valuation, or by selling it to another market participant who would use the asset its highest or the best value. So we always use the highest and the best use value for investment properties. So the 25 million will be the right answer. So you have to justify your answer rather than but just saying that it should be valued at 20 or 25. The highest and the best use of the non-financial asset takes into account the use of the asset which is physically possible. The condition is this type of arrangement should be physically possible, legally permissible, and financially feasible. So you can see in the scenario that the government has already given the approval. So we have got the legal permission, and the change from office to industrial units is also physically possible, and financially it is more viable to convert into rather than using as an office. So the investment property should be valued at 25 million. So this is actually the justification why it should be valued at 25 million. Now, in market conditions where the investment property is actively purchased and sold, the fair value measurement might be classified in level 2. So the most important point is that where we buy or sell the property, IFRS 13 specifically says about the property that it should be valued under level 2. Why? IS 13 provides property specific example stating that the level 2 input would be the price derived from the observed transactions involving similar property interests in the similar location. So you cannot use input level 1 because every property is not similar or identical due to the lack of active market for the identical assets. That's a very important point. It would be rare for the property to be classified in level 1. So we cannot use level 1 for the property valuation. We always use input level 2 or input level 3 for the calculation of property. And what IFRS 40 says about the conversion: transfer to or from the investment property should only be made when there is a change in the use. So the office is going to be changed into the property which will be held for the rental purpose. So now previously we are using the property as an office, but we are going to change the use of the property and it will be used as a rental purpose property, which is evidenced by the end of the owner's occupation, which has been in the case. For a transfer of the owner's occupied property to investment property carried with fair value, IS 16 property owner should be applied up to the date of the reclassification. So the date when we have changed the intention to use the property, we have to follow IS 16 up till that date. And after that, we can follow IS 40. But the difference between the carrying amount and the fair value should be considered as a revaluation gain under IS 16. So here you can see that there is an implication of IS 16, IS 40, and at the same time there is an implication of IFRS 13. So I'm going back to the previous slide. Now what should be the accounting treatment for this adjustment? The first thing is that we should have to consider that the directors of the canton wishes to know whether the fair valuation of the investment property is in line with the IFRS. So you have to justify your answer according to the provision of IFRS 13, that whether the valuation is in accordance with the provision of IFRS. So we have to use 25 million instead of 20, and you have to give the justification by writing your in the answer that you have to take the value which is for the best use and highest value. Secondly, before transferring the property into the investment property, we have to apply the provisions of IS 16. So we have acquired the property on 15 million for 15 million on 1st March 2014, and we have changed the use at what date? At 28th February 2017. So till that date you have to charge the depreciation. So what should be the depreciation till 28th February 2007? So the depreciation should be please calculate the depreciation. I think it's 1.5. 15 divided by the useful life of 30 years, and for the 3 years it will be 1.5. So before the transfer, the value of this property is 13.5, and now from this date we are going to show this property at the value of 25 million. So there is a difference of 13.5 minus 25. There is a difference of 11.5. This 11.5 should be reported in the revaluation reserves account. So this is very important to understand that before the transfer of the property from owners occupied to investment property, we have to follow the provisions of IS 16, because we are moving from owners occupied to investment property. So first we have to calculate the carrying amount, and then we have to take the fair value of the investment property, and the difference of 11.5 million will be recognized in the revaluation reserve. Whenever we book the gain in the revaluation reserve, we have to show it in OCI as well. So these are the adjustments that you should have to understand. So in this part of the question, we have revised some of the provisions of IFRS 13, some of the tools of IS 16, and at the same time some of the areas of IS 40. So if you have any question. Are the fair value gains posted to the OCI? No, when the property will be transferred, an investment property, the subsequent gains and losses will be recognized in the income statement. So here we have another question for you. So I want all of you to please read the question and tell me which standard should be applicable and from which standard, through which standard we have to solve this part of the question. So I'm giving just 2 minutes to please read the question. And Okay, let's start. So my requirement for all of you who are attending this session and or planning to attend this session on a regular basis, my request for all of you is to email me. I have already given you my email address. Email me your answer of the consolidation question and the answer of question number 2 that we are discussing right now, or we'll be discussing till the 9 a.m. 9 p.m. according to Pakistan Standard Time. So it is highly recommended for all of you to please do solve the question and send it to me. You can email me, or even you can solve the question on your notebook and take a picture from your cell phone and send it to me on the WhatsApp. I can tell you that whether you are going in the right direction or you are on the wrong track. So it is very important for all of you to please try to attempt this question and follow the guideline and instruction that I am telling you. Trust me, definitely you will pass the exam in first attempt if you follow all my guidelines. So next, start this part. Kento acquired all of the share capital of Binlori. This is the very useful part of the question, an important part. So from this part, you can easily pick that the requirements of IFRS 3 will be applicable to this part of the question. A company which manufactures and supplies industrial vehicles, okay, at the acquisition date, Binlori has an order backlog which relates to a contract between itself and a customer for 10 industrial vehicles to be delivered in the next 2 years. So company has got a solid contract and company will get the benefit from this contract as the company has to sell 10 industrial vehicles to the in the next 2 years time. In addition, Binlori requires extensive use of the water in the manufacturing process. So water is actually the need of the company to manufacture a product and can take a predetermined quantity of the water from the water source for industrial use. Binlori cannot manufacture vehicles without the use of the water rights. So the water rights is very useful for the company. So company cannot use the water, company cannot produce or manufacture a vehicle without the water rights. So it can affect the production or the manufacturing process if the company do not have got the water rights. Binlori had the first entity to use the water from this source and required the legal rights at no cost several years ago. So the right is being received by the company at no cost. So Binlori has the right to continue to use the quantity of the water for the manufacturing, but any unused water cannot be sold separately. So you cannot sold the water rights or water separately. So these rights can be lost over time if non-use of water source is demonstrated. So if the company is not being able to use the water, the rights will be withdrawn. Or if the water has not been used for a certain number of years. Binlori feels that the valuation of these rights is quite subjective and difficult to achieve. The director Kento wishes to know how to account for the above intangible assets on the acquisition of Binlori. So when we acquire a company, IFRS 3 says that you have to recognize all the intangible assets and you have to recognize the goodwill for the acquisition. So we have two contracts. One is order backlog, and the other case is water rights. So what's your opinion that whether both should be recognized as an intangible asset, or backlog contract should be recognized as an intangible asset, or water rights cannot be recognized as an intangible asset, or both cannot be recognized as an intangible asset? What's your opinion about this scenario? What is your answer about this scenario, that whether both rights should be recognized as an intangible asset? Please write your answers in the chat box. Please write your answers in the chat box. Only water rights. There is a answer from the student side that only water rights should be recognized. So whatever be the answer, you have to justify your answer in front of the examiner, that why you are saying that the water rights is an intangible asset, or water right is not an intangible asset, or order backlog is an intangible asset, or it is not an intangible asset. You have to justify your answer according to the provisions of IFRS 3 and IS 38. So what are the provisions? So we have to move towards the slide relating to this part of the question. Now what IFRS 3 says? IFRS 3 business combination states that an acquirer should recognize separately from the goodwill. The acquirer should recognize separately from the goodwill the identifiable intangible assets. Now what is the meaning of identifiable assets? Identifiable assets are the assets which can be purchased or sold separately, which are separable, which can be dealt with separately, which is not attached with any other asset. For example, customer satisfaction and goodwill. Customer satisfaction and goodwill are not identifiable assets, but the goodwill and the software, these two are intangible assets, but these are identifiable assets. So IFRS 3 says that you have to recognize all the intangible assets separately from the goodwill, which is identifiable. An asset is identifiable if it meets either the separability or contractual legal criteria in IS 38 intangible assets. Customer relationship intangible assets may either be contractual or non-contractual. Contractual customer relationships are normally recognized separately from the goodwill. So here you can see that the backlog, as we have got the contractual right of the backlog agreement, therefore we can recognize this backlog as a intangible asset because we got the legal contractual rights. However, non-contractual customer relationships are recognized separately from the goodwill if they meet the separable criterion. So non-contractual rights, like the right of the water that we have been received, there is no contract. This is the right which is just given to you. is only be recognized when it meets the separable criteria. Separable criteria means that this contract can be used separately from the operations of the business. So as you know that uh, the water is important and necessary for the manufacturing, and we cannot sell the water separately. So this contract of water is totally connected with the manufacturing. It is not actually separable contract. Consequently, determining whether the relationship is contractual is critical to identify and measure both separately recognized customer relations of intangible asset and goodwill. And different conditions could lead to substantially different amount of accounting outcomes. So from this perspective, you can say that backlog contract should be recognized as an intangible asset, and the water contract as it is not a separable contract. Therefore, this right cannot be recognized as an intangible asset. So we cannot recognize the water rights as an intangible asset. Rather, we can recognize backlog contract with the customer as an intangible asset. So this is how you have to justify your answer according to the provisions of IFRS. So now let's move on towards the next slide. So here is a question for you, and please read the question and write your answer in the chat box that from which standard we should have to solve this question. From which standard we have to solve this question. Please write your answer in the chat box. One standard has write IS 36 in the chat box. The other one has wrote IS 37 impairment. IS 37 is relating to provisions actually. IS 37 is not impairment. So you rightly said that this adjustment should be dealt with according to the provisions of IS 36, and it is a very simple part of from the scenario. So it is a very simple part of the question that Cantor acquired a cash generating unit. Cash generating unit means smallest identifiable group of assets that generates cash independently. This is called cash generating unit. Several years ago, but at 28 February 2017, the directors of the Cantor were concerned that the value of the business of the CGU had declined. The value of the CGU had declined because of the reduction in the sales. Now this part should be considered as an impairment indicator. At 28 February 2017, the carrying amount of the assets in the CGU before any impairment tested were goodwill. We have got the goodwill with the value of 3 million, property, plant and equipment, and other intangible assets. Now what IS 36 says about the impairment? IS 36 says that whenever the carrying amount is greater than the recoverable amount, then you have to book the impairment with the difference. But it is not required to calculate the recoverable amount annually unless you have some impairment indicator. So if you have some impairment indicator, then you should have to calculate the recoverable amount. Otherwise, there is no need to calculate the recoverable amount. But there are few assets for which you have to check the impairment annually, and the requirement is compulsory for annual basis. The first area is goodwill. If the company has got a goodwill, then it should have to calculate and test the impairment annually for that goodwill. Then if you have intangible asset with an indefinite useful life or intangible asset not yet available for use, these two assets should also be tested for the impairment annually. The rest of the assets should be based on impairment indicator. If there is some impairment indicator, then you are required to calculate the recoverable amount. As you can see that there is a reduction in the sales and we have a goodwill in the CGU, so you have to calculate the recoverable amount. The fair value of the property, plant, and equipment. Now, but you should know that recoverable amount is the higher of net selling price and value in use. So actually the recoverable amount is the higher of net selling price and value in use. So the fair value of the property, plant, and equipment and other intangible assets are 10 million and 17 million respectively, and the cost to sell is 100,000 and 300,000. And we have been given a pre-tax cash flows and post-tax cash flows for this. Then the pre-tax discount rate is 8% and the post-tax discount rate is 6%. Do remember this point that whenever you are going to calculate the present value of an asset or a liability, we always use pre-tax rate. Post-tax rate is only used for appraisals, is only used for investment appraisals, and when you are going to evaluate a particular investment, whether it is feasible or not, then we have to use the post-tax rate and post-tax cash flows. So we always have to use the pre-tax rate and pre-tax cash flow. So this 6% and post-tax cash flows are irrelevant from this scenario. Cantor has no plan to expand the capacity of the CGU and believe that a recognition would bring cost saving, but has as yet no plans to be approved. The director of Cantor needs to advise on whether the CGU value is impaired. So the carrying amount of the CGU is 32 million. So all of you are required to calculate the recoverable amount. It should be the higher of net selling price and the value in use. Please do calculate the recoverable amount. Value in use is actually the present value of the future cash flows. So we have not been given the fair value of the property, plant, and equipment and other assets are 10 million and 15 million, and the cost to sell is 100 million and 300,000 respectively. But we have not been given the fair value net selling price of the CGU. So all of you are required to just calculate the present value of the future cash flows using the pre-tax rate and pre-tax discount. Please calculate the present value of the future cash flows for this question so that we will be able to solve the question further. What is the present value of the future cash flows? Using the discount rate of 8%. Please calculate your answers and write your answers in the chat box. Now the recoverable amount at the 8% is approximately 28.44. So the carrying amount is greater than the recoverable amount. So there is an impairment loss of I think 3.56. This impairment loss should have to be allocated between the goodwill, property, plant and equipment, and other assets. So the final answer should be 28.44. So first of all, we have to apportion the whole of the impairment loss into the goodwill, because according to IS 36, the goodwill should be first apportioned against any goodwill. Impairment loss should be first apportioned against any goodwill, and the remaining amount will be apportioned between the other assets on the pro rata basis. So for pro rata purpose, we got the property, plant and equipment with the value of 10 and other assets with the value of 19. So the weightage for property, plant and equipment is 10 upon 19. And the weightage for this part is 29, 10 upon 29 and 19 upon 29. So what is the value of the property, plant and equipment when we allocate 0.56 in the ratio of 10 upon 29? So the 10 upon 29, 10 divided by 29 into 0.56, there will be the value of 0.19. So when we deduct 0.19 from the 10 million, we got the value of 9.8. But in this question, you can see that the property, plant and equipment has got the fair value of 10 million and the cost to sell is 100,000. So the net amount is 9 million actually. It's 9.9 million. So we cannot charge the impairment below 9.9 million because the fair value of the property, plant and equipment after the cost to sell is 9.9. So at maximum we can charge the impairment of just 0.1 and the value will be 9.9. So out of 0.56, when we have charged 0.1 in the property, plant and equipment, then the remaining amount of 0.46 will be recognized in other assets. So when we deduct 100,000, is it in millions? (0.1) minus 0.56, we got the value of 0.46. So finally we got the value of 19 minus 0.46. There will be value of 18.54. Okay. How did we get 28.44? Now there is a question from the student side that how did we get 28.44? What I have done that we have to calculate the present value of these future cash flows at the discount rate of 0.8. So by multiplying with the discount rate of 0.8 for each year, 8%, 8%, 8%, and 8%. It should not be like this that we have to calculate the present value by multiplying 8 into 8%. We have to multiply 8 into the discount factor of 8% for year 1 The discount factor of 8% in year 2, discount factor of year 3, discount factor of year 4, and discount factor. By multiplying these two, we got the present value of the future cash flows, that is 28.44. So the difference between the carrying amount and the recoverable amount will be 3.56. Okay. So the first part is we have to charge the full amount into the goodwill unless the goodwill becomes 0. So the goodwill is 3 and we have to charge 3 million in the goodwill. So the remaining amount of 0.56 should be distributed on the pro rata basis, but the value cannot go less than the fair value. Therefore, we have booked the maximum impairment of 0.1 in the property, plant and equipment, and the remaining amount will be charged in other assets. So this is how we have solved this question, but for the examiner's point of view, you have to write at least few points of IS 36, like what is impairment, what is recoverable amount, how we calculate the impairment in this question, and what should be the pattern for the allocation of the impairment loss. So you have to write few words relating to IS 36, and then you can solve the question by numbers. Don't focus only on the numbers. Please start your answer with the provisions of the relevant IFRS and then try to solve and work on the numbers. The number crunchers are not going to pass. Only the number crunchers will not going to pass this paper if you will not be able to write the provisions of the relevant IFRS. So I think the time is almost over. Only 2 minutes left according to the timings, but I'm telling you two things and the way to prepare. I'm telling you some useful tips for P2. First of all, focus on the question that I have been given to you. Please try to solve this question and email me. I will be waiting for your email addresses, emails about the question 1 and question number 2 of this paper. Tomorrow we will try to solve question 3 and some other questions of the paper. And secondly, all you need to do is to revise. I will provide you, if you want, I can provide you a few summaries of the relevant IFRSs, but revision of the IFRSs and memorizing the key provision is very important to pass this paper with good marks. And believe me, if you write your answer, you can even score 70 plus marks in this paper. It's a high scoring paper. So focus on the first 35 marks of the consolidation and the remaining question number 2 and question number 3. I will give you some hints for the question number 4, but it's more logical to prepare yourself for question 2 and 3. And because for question number 4, examiner is open, he can ask anything from the syllabus or even from outside the syllabus. So it's highly recommended to work on question number 2 and 3. And if you have some issues in any IFRS, you can ask me directly on the WhatsApp group, and you can email me your answer. I'll be waiting for the answer of question number 1 and 2. I want to see the emails on my email. So thank you very much. And if you have any question for this part, you can ask. Otherwise, we have to finish our today's session. If you have any question. Sir, which one is your WhatsApp group? Any link? It was an eye-opening. Thanks a lot. So the management will provide you my WhatsApp number. You just message me and I will add you on the WhatsApp group. I haven't prepared the WhatsApp group today, but I will prepare it today. So don't you worry about the WhatsApp group, and even you can email me if you have some queries. But do remember this, attempting the simple questions is very easy, but attempting the past paper questions is should be the way that you should have to prepare yourself in this month. So please focus on the past paper questions rather than simple questions of the handouts or some material or some notes. So it is highly recommended to solve the past paper questions and try to attempt at least 3 to 4 past papers completely in a 3-hour session. This will give you the maximum benefit. So do you think still have time for December sitting? Yeah, you can easily prepare yourself in just 10 to 15 days for P2. P2 is not a big challenge to pass this paper, because it is very easy to gain marks in paper P2. So even if you have got only 15 days, you can pass the paper. But the thing is that you have to follow the right path, you have to follow the direction, and you have to follow the basic points that I'm telling you. Please share the brief notes for all the IFRS and ISS. I will share the notes and summaries of all the IFRSs on the WhatsApp group. So don't you worry about the notes and summaries. So thank you very much. Inshallah, we'll discuss the further part tomorrow. Thank you very much.